So good morning. Today is January 25th, 2017, and I've been studying a pattern in the daily cycle markers in the daily end of day bars for gold futures. And today in the upper right hand corner you'll see that we have the 0217 contract. And I woke up early this morning and had a feeling that I was going to see something important if I would just get out there and look. And I've made a discovery that I was hoping you might want to take a peek at and sort of analyze on your own time and see if you don't come to the same conclusions. We've had a fairly large regression in the price of gold starting back here in October especially. There's been a pretty significant drop down into the 1120 area, and now we're pulling back up and are above the $1,200 area. The nice part about the analysis we're going to do is that it enables us to be predictive as opposed to reactive. And I want to review with you what I've discovered here this morning. There's a very unusual pattern in this market that sort of had me perplexed and started me searching for past iterations of it. As you know, we're using predictive Ninjatrader indicators, and the Ninjatrader indicators that we're using are predictive in that they follow one of 4 different phases with the daily cycle marker tool. So if you have the Flux daily cycle marker tool, or if you have the investor package, you have this tool as well. And there are a series of 4 repeating phases that occur. So for example, this little green dot is a phase 1. This large green dot is a phase 2. This little red dot, is a phase 3. So everywhere you see a little red dot is a phase 3. Everywhere you see a large red dot is a phase 4. Everywhere you see a little green dot is a phase 1. Everywhere you see a large green dot, is phase 2. So those 4 cycles just repeat. There's an energy cycle in the market, and it just follows through like 4 seasons. 1, 2, 3, 4, repeat. 1, 2, 3, 4, repeat. 1, 2, 3, 4, and so on. And the nice part about this predictive Ninjatrader indicator is it tells us in the upper right hand corner when the next event is coming. So you'll see in the upper right hand corner that the next phase 4 is expected here shortly in the next couple days. So again, I come back to this initial observation. The entire move starts to reflect. There's a clear repulsion away from the low of this phase 3. Remember, phase 3 is a little red dot. And we're currently at a phase 3 right now here at the top. And I started searching. For something called an analogous pattern. Analogous pattern. Analogous is one of those fancy highfalutin words that means comparable with certain aspects. There's a similarity between the two. And I took a few moments this morning, got up extra early, and started looking for something that looked like this, where we had a consolidation period, we dropped down out of it, we bottomed out at an L or a phase 3, and started to reverse and come back up into a phase 3. And here's what I found. If you compare these two things left to right, you should see some similarities right off the bat. And if not, that's okay. We're going to go through it together. What I found was back in 2013, there was a very similar movement in gold. And that movement started at a consolidation area breakdown, just like we had over here on the right hand side. So do you see the similarities from the 2013 pattern where it broke down into the final drop at A? And then on the right hand side, it's not too big of a stretch to see that in fact there's a very similar analogous pattern, there's that word again, over on the right hand side. Okay, so when you're searching for analogous patterns using the predictive software, using these Ninjatrader indicators for predicting what markets will do, allow your eye to see those kinds of things. And over a period of time, when you start to look for them, you'll begin to find them faster. So let's sort of walk it forward from there. Over on the left, you'll see that I've sort of brought things into line with what's over on the right. I knew that L was a bottom in the 2017 cycle. And my analogous pattern over here on the left shared a very similar attribute. You can see that the L, here we're off by 1 day, more or less, but there's this sort of bottoming pattern at L, and then it reverses back up. Well, it's the in-between stuff that has me particularly fascinated. And let me share what I mean. In the 2013 pattern, A is the high of the leg before, just before it drops out of the consolidation area. In 2017, A is the high of the leg just before it breaks out of the consolidation area. That move stops at the next phase 1 event. Little green dot is a phase 1. In 2013, we had a very similar reversal. So that first leg, that A to B, that I've denoted here with no particular purpose or reason for the lettering, that's just where I started it. That drop is mirrored 4 years later. Then we see that we have B and C starts to move up into D and E in 2013. Over on the right hand side, you'll see that B and C start to move up into D and E over on the right hand side. Now here's one of the only differences that I've noticed between the two patterns, and that is the F pattern in 2017 was high and the F pattern in 2013 was low. But G defines the bottom of that drop out of that first retracement right here. And if we come over here and look on the right, you'll see that G defines a rest area. Okay, so we've sort of got the DE, BC, A, again, all pinned down by the anchors of these predictive Ninjatrader indicators. Okay, so A to B, B up to D and E, E down to FG, okay, then up into H, and then over here we'll see where we're at. We're at H, right? Look what happens after H in both patterns. H gives the marching orders to drop. H is a trigger day for the banks that are running these plays to say, all right, let's start the descent. Let's begin the fall from grace right here. Satan loosed from the heavens onto earth. And in much the same way that A, this phase 4 pattern, released the markets in 2013, kind of punched a hole in the bathtub. H is a punch the hole in the bathtub moment. And so it drops, but now watch here. I becomes a drop down in 2013. I becomes a drop down in 2017. J can't hold the market up. J is a phase 1, which usually pushes gold higher. J in both cases is a breakdown out of consolidation. It's a breakout out of these 1, 2, 3, 4, 5 bars of sideways movement. Over here, same thing. 1, 2, 3, 4, 5 bars of sideways movement. And then J in both universes, in both times, 2013 and 2017, is another hole in the bathtub moment. It's a breakout of the lows and a continued drop down. K is a hole in the bathtub moment. Same thing happens on both sides. There's a period of consolidation, 1, 2, 3 days, and then a drop. On the right hand side, 1, 2, 3 days, and then a drop. So there are remarkable similarities between a 4-year-old pattern and the pattern we're seeing play out right here 4 years later. Again, all anchored by these Ninjatrader indicators, this daily cycle marker tool that we're using. That's Predictive. You would think that's sort of where it stops. And that's not where it stops. If anything, things get really interesting right in and around this area. Now, I'm going to pull this down and spread it out. And check this out, those of you watching at home. One of the things I've started to notice in our analogous pattern search is that the numbers these patterns occur at, whether they're 4, 8, or 10 years in the past, reflect the numbers that we're at in the present. Let me show you what I mean. In 2013, we sort of have this meteoric rise, this parabolic rise into the high that we're seeing on the left-hand side. That is to say, the phase 3 moves higher, the phase 4 moves higher, the phase 1 moves higher, the phase 2 moves higher, and then things peter out right around this phase 3, this P that I've drawn 4 years before. But if I take just a couple triangles, can you see how in 2013 we have this channel trade? The market just slowly works its way up this channel up into the P phase. Okay? Well, the same thing happened in 2017. And where L was the low, this phase 3 event, we just start working our way up this channel. Very parabolic move up here, just very fast and reactive. And then things start to slow down. There's a consolidation phase. That's where we're at with this blue rectangle. Over here on the right in 2017, there's a blue rectangle that I've drawn. And I just want you to see where price is in relation to that. Okay, so far so good. In 2013, P is the counterpoint to L. We've driven all the way up. So we have K, L, P. Now look over here in 2017. We have K, we have L, and we have P. Now, if you still think the markets are random at this point, there's not much I can show you to convince you otherwise. You just sort of have to figure it out on your own, which is usually a bloodier, head-banging experience over the years. But if you're open to the idea, the predictability of the markets tends to really get fascinating at this point, because now I've put a vertical line at P in both the past and the present. And one of the great parts about this technique is once I've anchored a pattern in the past, I have a blueprint to follow for the future. So all of this stuff to the left has been playing out. Now it affords me the opportunity to look forward this way. It affords me the opportunity to say, well, if that's the present now in the past, what happened after? What happened after P in 2013? What happened after this phase 3 event called out by that Ninjatrader indicator? Well, as I mentioned in the chart, we're headed towards a phase 4. This is what's next. A phase 4 is next. And on the right hand side, we don't have one of those yet. So I'm very interested in the behavior between P and what will be Q when we arrive there. Get your P's and Q's together. Know your P's and Q's, right? One of the things I notice is that in 2013, P is unsustainable as a high short term. we have a consolidation area that breaks down into a phase 4. The close of the phase 4 day is a rocket launch. It's the beginning of the next ascension. Over here on the right, we're not near the bottom of the consolidation area yet. As best as I can figure, this is the consolidation area that we're currently in, defined by the highs and lows of the candles that I've drawn. So I'm assuming that P will be a consolidation area in the present. And the low of that currently is 1200. So far, so good? Okay, so there's two assumptions that we're making moving forward. Assumption number 1, or observation number 1, Q, or the phase 4, is a low close up reversal. That means that in the past, the candle closes near the low and then reverses up the next day. That's the first observation that we can make. Number 2, the phase Q, the phase 4, is below the phase 3 price. So if we look here in the past, the phase 4 is below the phase 3 price. Okay, those are two of the characteristics of what happened in the past. Now here's what's really interesting. Q in 2013 retraces off of a strong psychological number. In 2013, look at where Q falls to. And tell me if this doesn't blow your socks off. That's 1300. You'd say, well, what's the big deal? I'll get as close as I can. That's pretty close. Why is that a big deal? Well, where are we retracing to currently in 2017? Where are we pulling back to? Where are we retesting right now? Boom, 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 boom. Let's go ahead and write that number down. That's 1300. So it retraces a Q to 1300 and then goes up. Anybody see where we're retracing to now in the present iteration of the pattern in 2017? It's 1200. What are the odds of that, do you think? What are the odds of us retracing to a psychological number that's off by $1,000 or $100, forgive me? They're pretty high against that we would see all of these patterns playing off of each other in this configuration with these kind of channels, with this consolidation, with the low at a phase 3 event, pulling back into a phase 4 to a strong psychological number. The odds of those things all occurring in sequence, one after the other, are pretty remarkable. And so now what we can assume, or what we might assume, is that there'll sort of be this drop down into 1200 where an opportunity exists. If we just sort of imagine with our eyes where we might go from there, it tells us two things. Number one, that there's a $7 move potentially between where we are right now and the low of the phase 4 coming up. In fact, if you look here, the low in the past was 1295, essentially 1294.7. If you put a line over here at 1195, that's sort of right in the area, right? You'll see that there's the potential here for a $12 drop in gold. Okay, and that's where things start to become really interesting, because if in fact the phase 4 that's coming up is the bottom, there are several things I want you to watch for moving out. Number one, look for a large low close day. Number two, look for a doji style day. Look for a small spinning top, very small bodied candle. Okay, so there's a trigger of events that occurs. Phase 4 in and around this area, it might be a day or two off, but look for that low close drop day down into 1200. Look for that sort of exhaustion candle right here near the low that punches the stops one last time, goes underneath the strong psychological number, and then you can evaluate your risk at that point for a longer term trade in gold. So at that point, if we see that kind of candle here on the right hand side, then say for example, this is our big down drop day right here, and then we have that small bodied candle right there. It's fairly rudimentary to say that your risk should be just below. If you enter here, then there should be a play back to the top of the consolidation range, which will be another $10 or $12 up, and then a breakout above. So there should be a very low risk to reward ratio over here on the right of the phase 4 coming up next. So in conclusion, when you're looking at the markets with a predictive Ninjatrader indicator, try to anchor the patterns with the time cycle markers that you've got. This will work intraday too. It's just harder to see it because the market's moving faster, and we're getting a pattern every couple minutes or every couple hours as opposed to every couple weeks. But in comparison now here, looking at 2013 in relation to 2017, you can sort of see where we're at and what might happen moving forward if the market makers continue to follow the footsteps that they've laid for themselves in the past.